I consider real estate like boxing, action, reaction. Your action is to react when someone has come to hit you. It's the same with the property market. There's never a good time.
The right time is always now, I believe. But if you're buying an asset now, and if you're not planning on flipping it the next year, you're always going to be okay.
Real estate and finance are crucial elements of a household. You've got to link yourself in with a real estate agent who knows the business, who's out there to help and add value to the relationship and to educate the client with informed decisions. Being a home owner, it's a pressure cooker. Diamonds, how do they form? Under extreme heat and extreme pressure. Hello and welcome to another episode of From Why to Wealth. We're an education-based platform helping mums, dads and business owners achieve their financial objectives. We just so happen to do loans. On today's episode, we'll be discussing a little bit more about real estate, and we'll be joined by Andrew Ganami, our finance broker, and property expert Jason McHale from the Property Co Group. Jason, thank you for joining us.
Thank you for having me back.
God, mate, it's lovely to have you back, Jason. The energy that you bring to these is fantastic. Andrew, you well today?
I'm well, thank you. What about you?
Oh, fantastic. So, I mean, we're going to narrow this particular one into the New South Wales market, and Jason's part of the Property Co Group, who have a few offices, cover predominantly West and the Shire. So you're seeing a real diverse market at the moment between the both, I wouldn't necessarily call it regions. But, you know, today what we're going to be discussing are the market trends, investment opportunities, and the market drivers. So I guess the market trends, narrowed down to a few that we've come to look at, is the housing demand, the growth, particularly what we're seeing now through buyers agents as well, the regional growth and property type. So with respect to housing demand, your major cities, particularly Sydney, New South Wales, are known for high property values, driven by demand, population growth, and urban amenities. We've touched on this before with previous podcasts that you joined us on. And one of them was property developers speaking with local councils about what urban amenities they can introduce to help Greenlands, for example. That's just a little example. But you've also mentioned the supply is high but the demand is low, or was that vice versa?
Yeah, so like depending on how you kind of look at it, I think when we were last discussing this, we were talking about supply being low of apartments and because of the lack of building or even any really new development. But what we've seen over the last 3 months, like in particularly the Sutherland Shire market, which if you look at the Sutherland Shire market, it's the whole Sydney market mirrors it usually. What we've seen is a huge amount of stock increase. So I know rough numbers in Sutherland Shire 3 months ago, maybe even 2 months ago, there was about 600 properties available. And now we're looking at around 900 or close to 900. So that's close. It would sit somewhere around the 40% increase mark, but it's close to 50.
Keen to understand, you're doing this day in, day out. You got 300 more properties than what you did this time last year, did you mention?
No, even just from 3 months ago.
3 months ago, sorry. Where are you seeing the gap?
Well, to be honest, I think it's supply that we actually needed. I think through the previous 24 months, supply has been low across the whole of Sydney. Speaking to other agents in other areas, they've all found the exact same thing. So I think more than anything, I think the extra supply is kind of weighed out with the demand that we have.
But are you saying that's due to people selling, downsizing, or are they looking at moving out of area? Because look, from 600 properties for sale to 900.
Look, leading into spring and summer, we tend to always get extra stock. I don't think that there's any particular one reason, but I think a lot of people have gotten to the point that they're sick of waiting and they do want to make some kind of transactions. But one thing that we've kind of discussed and touched on before is it's actually quite difficult for a lot of people to move at the moment. When a couple of years back, they got their $2 million mortgage and at 2%. Now, if they go back to the bank, they can't even get that $2 million again. So it makes it quite difficult to make a move for some people.
We do talk on a regular basis with how the inflation, how it works, and just so many factors that come into consideration. And until that moves in a positive way without the injection from the state or federal, I guess, until that time, we're probably going to see this trend continue. But then I've noticed, dealing with a broad range of clientele, people are starting to look at regional properties. There has been a growth in that. That's partly due to the increase of remote work and lifestyle changes. post 2022. Are you seeing that as part of the driver or the motivation to sell, or?
Yeah, like I think even when we're selling a lot of properties in the south, we're tending to see probably about 60% of our buyer pool actually coming from the eastern suburbs or inner west. So they're coming down south. And then I would say probably 20 to 30% of the people that we actually sell for are actually even moving further down south as well. So there is a trend of people kind of moving out into cheaper price points or, more kind of coastal areas. Speaking to even agents down in the south coast, around the Jervis Bay area, they kind of stopped seeing a lot of buyers actually come down to their area where they had that huge rush post-COVID.
I think that's post 2022. I believe that's due to the rules being enforced, that the return to work. A lot of people had the belief that working remotely, I think running a business, it works, right, for the right people. But a lot of them are probably saying, hey, we did make the lifestyle change. There is no employment down here. Like in Sydney, we need to shift back to Sydney, for example.
And we have seen that. We have seen people coming back. So yeah, I think it's quite an interesting move. But yeah, what we're seeing mainly is people from the inner part of Sydney kind of moving out to get a little bit more value for their money.
Having you placed at the Cronulla office, are you seeing that same thing, Andrew, with clients and the conversation piece, or it hasn't really been brought up with lives at all?
To be honest with you, the last 3 clients I've dealt with, exactly what he said, they're starting to migrate south. A, because of the prices. B, living situation. And 3, honestly, your bang for your buck. Down south, you can probably get a land and a house, whereas the more sort of east and towards the Cronulla and a bit of a west, you're looking at an apartment for the same prices, I guess.
I think people have also changed the idea of what they're hoping for. I think what we're finding is people love brand new, people love a pool. They're happy to sacrifice the large block size and have brand new duplex, smaller block size, but all brand new and everything that they want in a home.
Let's be frank, nobody likes doing gardening anymore. And nobody
that's probably the one of the biggest reasons behind it. Everyone wants to learn.
It's people are having, some people have 2 jobs, some people have 3 jobs, very minimal that I talk to have the 3rd job. But then it comes down to property types, right? We're just touching on that, where detached houses, they've been dominating the Australian market for how long? But there's a growing interest in apartments and more so townhouses, particularly due to affordability. I mean, you're paying for a 3-bedroom, for example. Let's give an example, 3-bedroom, 2-bedroom, paying $1 million, right? If you're looking at a 2-bedroom, 3-bedroom house, you're paying 1.5 plus. So the thought process would be, let's buy the $1 million apartment in the hope there's capital growth, and the $500,000 extra we would have paid. We just got to visit that local park a little bit.
That's actually an interesting thing you say, because if you say that a good brand new 2-bedroom unit is, say, close to $1 million, in those same areas, a house is probably 1.6 to 1.7. So you're calling it an extra 70%. But if you go back to, say, around 2020 or even earlier, you'd see a unit would be worth 700,000, but then a house would be 1.112. So the gap between a house and an apartment has actually grown quite significantly over the last 4 to 5 years.
It was actually interesting between the 2021 and the 2020 and 2022. In the midst of the pandemic, there was so much false reporting with house prices dropping. What they weren't watching is the clearance rates dropping. Clearance rate dropped 70% because you couldn't attend open homes. Do you remember the virtual tours? And then media were coming out and going, oh, they've dropped considerably. Well, it's just a given. It's just, if you're not auctioning properties. And
well, look, even clearance rates, for people that don't know, the way that the clearance rate results work is realestate.com, Domain, RP data will usually call you on a Saturday afternoon after your auctions. And I know most agents just probably don't even answer the call, even if they have sold it. So I think a lot of their data on the Sundays and Mondays are quite skewed. I don't think it's a real reflection of what's happening on the market.
Jason, you were telling us you take phone calls at 9:30 at night.
Yeah, sometimes.
Yeah.
Depends who it is.
Yeah. Depends if it's a do not answer. Now I know why you don't answer my calls after 9 o'clock at night.
Nah, your calls all the time.
But look, real estate in general across Australia, it's much the muchness.
Yeah, of course.
It's much. And you go to those high-end areas and you're buying a unit, like let's just look at this, in the west, you're buying a 3-4 bedder for 1.2, 1.3, whereas you're buying a 3 bedder near the Shire for 1.2, 1.3 unit, that is. So, I mean, it comes down to preference.
Well, I have found with apartments, I've found that like a 3-bedroom or a large 2-bedroom has actually become more acceptable from downsizers recently. I'd say, and I'm not too sure why that exact change. I think people have just adapted with the modern kind of way
It's
of
the
living.
new generation. I'm
Yeah.
not saying they're lazy, but I like generally speaking.
I'm even saying from a downsizer perspective, like I would say 10 years ago, if I had someone in their 60s or 70s wanting to downsize and want to go to a villa, they would only look at a villa and they wouldn't consider an apartment. Now I have people saying, oh, we would really like a large kind of scale apartment. So it's quite interesting the way that things have changed. And from an affordability perspective as well, what you can get for a 3-bedroom apartment in comparison to a villa, because villas are they hardly come up. Everyone goes crazy for them. The value for money you get in an apartment over that is incredible.
A very interesting point there. Relationship to me personally is an infinite game. I use that word a lot, infinite. Thank you, Simon Sinek. But the reason why I use that word infinite is just when it comes to market trends and housing, the diverse market, you've got to link yourself in with a real estate agent who knows the business, who's out there to help rather than and add value to the relationship and to educate the client and with informed decisions. You're on the ground. I mean, I'm not going to go make an informed decision based off realestate.com and Domain because I'm just looking at the same houses continuously with the same agents having one priority, and that's to sell me the property. Whereas if you've got a relationship with an agent, the context of home ownership changes.
The thing is, stats don't have any context. I know that there's multiple suburbs that we work in that have got waterfronts. And if a couple of waterfronts trade in a certain period of time, then it just increases the median. And then you've got realestate.com or Daily Telegraph reporting that there's been a 15% increase in that suburb over the last 3 months.
But that's what happens.
And
then what do people do? They jump on that bandwagon and go, oh, it dropped or it increased.
And then I get a client screenshotting the article and sending it to me and saying, oh, has my property gone up 15%? Wish it has, but not really. So
but even then, there's a big disparity around valuers and again, guys, anything I discuss here is based off experience. And the reason for that is we had a client buy a property recently out west for 1.399. It's a duplex. The left-hand side they bought, unconditionally exchanged. Not even 6 weeks later, next door sold. Like for like building, like for like, 1.480. Now, did they pay unders or did the neighbor pay overs?
Yeah, it's
from a real estate perspective.
Well, to be honest,
and from a purchaser, you've just witnessed property A sell for 1.399, but you just paid 1.480.
I think it also just depends. Like I had a similar situation only 4 weeks ago where in Sutherland we sold a duplex for 1,950 at auction. There was one bidder that was persistent on not coming to auction. We then offered him the other side, which was the south-facing side, and he ended up purchasing it for 1,967,000. So 17. It's obviously not as big as the $90,000, $80,000 increase, but that's an extra $17,000 on not an identical duplex because the north side's always valued at more.
But it's interesting what trend you are, even with the downsizers, that they're willing to forego a villa and go a decent size unit. That's the interesting take. And are you seeing the younger generation getting into the property market tend to do the same, unit based rather than villa based? Yeah.
I think, well, the thing is, it's quite hard for a lot of young people to get mortgages over that $700,000-$800,000 mark, as you know.
I mean, you and I worked on a particular client that a few months back, and he was looking at a particular suburb, and the difference between suburb A and suburb B was about 120,000. And we ended up putting a proposal in place, making the recommendation with the assistance of a team to go, hey, this is achievable now. That's achievable in 12 to 18 months. But I'm getting married. Okay, if you're getting married in 6 weeks, we need to make it happen now. So they end up settling for the next suburb over, and they were still able to achieve the same goal of home ownership. And that's purely due to having a relationship with not only your broker, but your real estate agent, but it's even a more of a incentive when they both have the one common goal. You're seeing that too, correct, Andrew?
It always ties back to the objectives of the clients as well. I mean, some clients just want a property, want to get in property market, and they go settle for an apartment. Some others, they'll settle for a duplex or a home. Depends on the objective. And obviously it depends on their circumstances as well. Like you're saying, they were getting married. So it's obviously in their best interest to do so.
Even what you touched on about if they wanted the suburb they wanted, they had to wait 12 to 18 months. You look at that and the opportunity cost that they would have lost.
Yeah, too.
Like we've everyone's got their different market predictions. I've got mine around next year, and I believe that they'll probably end up losing out, and then that 12 to 18 months will end up stretching out because property prices will increase on what they were looking for.
You can't live on a hope and a prayer. You can't.
At the end of the day, we've seen dips in the property market for sure, but if you put it in what's the straight line graph, the one that goes up and down where it just averages it out, like
peaks and a trough.
Yeah. So if you just average out the peaks and troughs, you'll end up seeing that it's just always going up. And there's those stats that say it's 7% per year or 8% per year in the Sydney market.
I consider real estate like boxing, action, reaction. Your action is to react when someone has come to hit you. It's the same with the property market. There's never a good time, right? So when I say there's never a good time, a lot of people procrastinate around when's the right time to buy. Well, I can't predict that for you, nor can you in the real estate game. What we can do is guide and educate and just show them facts. And that's what I love. When you've got facts of the peaks, of the troughs, not necessarily what the media are reporting, and papers need to be sold, but generally speaking, it gives them that level of comfort that, okay, we don't need to make that transaction now.
Look, I've done a heap of research, and don't quote me on the exact numbers because I don't have it with me, but I've done so much research on the ups and
quoting
the ups and downs of the real estate market, and especially in Sydney. And you look at the downturns of the market, and they don't usually last for more than about 14 to 18 months. And that drop is usually recovered within the 2 years following. So as long as you're in it for a long-term play and you're not trying to flip it straight away, obviously there's the development perspective and that's different. But if you're buying an asset now, and if you're not planning on flipping it the next year, you're always going to be okay.
But investment opportunities continually pop up.
Oh, definitely. Right? Yeah. And like you're saying though, there's the right time is always now, I believe. And especially in a market where in Sydney, where we're so reliant on the property market for the whole economy itself. I don't think it's ever going to slow down from the perspective that people are going to lose so much on.
Being a home owner, it's a pressure cooker, right? And I've said this a few times, particularly in the last 3-4 days, diamonds, how do they form?
What's the exact expression? Under pressure.
Under extreme heat and extreme pressure. And this is where I come down to, yes, we have a market volatility, but if you can see this next 6 months out, there is light at the end of the tunnel, and continually repeat that. Our parents would have told us in 1988 when we went through...
when we had our 18% interest rate. Yeah.
But they're things where, their salary is at all-time low. Let's fast forward 30, 40 years, it's the same thing. House prices are an absolute sky high, and then they're not going to drop. The interesting thing is when somebody comes to me and says, oh, I can't wait for rates to go down. I go, yeah, why? Oh, my rent's going to go down. No, this is the new norm. Your rent's not going to go down. So how do we look at ways of trying to help you understand the market first and foremost, and what opportunities lie out there, and is it regional for you to buy and not so much local? Even you and I have touched on this on a personal and a business level of residential versus commercial in respect to investment opportunities. And one of the things we've said, both sectors offer different opportunities. Commercial real estate has a higher yield.
Yes,
we know that generally it's higher yield, and the entry cost is slightly higher because you've got to put more of a deposit. You can't get away, or you can with some lenders. You're looking from 20 to 35%, depending on what your circumstances suits which lender. But the residential properties, on the other hand, they can benefit from capital gains and rental demand, especially in high growth regions. Now, commercial, you're getting anywhere from a 7 to a 10% yield if you've got the right tenant in there. Yep. And they're usually covering outgoings and so forth. Residential is not the case. You're getting maybe a 4 to 5% yield.
Not to mention, they tend to stay there for a longer period of time.
Well, you got a 5x5, 3x3, depending on where you're at.
Your vacancy period when you're releasing it is obviously a longer period, but you
because
get
niche.
Consistent tenant. Yeah,
correct.
Yeah, like with residential, you might have a turnover of a tenant every 2 years, where on a commercial, like obviously every situation is different, but it might be only once every 5, 6, 7, 8 years. So,
and you can never be safe
in anything anyway.
Well, yeah, I mean, I know someone that owns a commercial property. His tenant signed a lease. He was positively geared. Outgoings were covered. Tenants come in and gone, I'm happy to pay the break lease and I want a bigger premises. Yeah. There was nothing that owner of that commercial property could have done. Yeah. There's nothing. But it's at the moment, he's got to go in, that particular individual that's there, he's got to clean the place out because it's a mechanic shop. But how long that may stay vacant for 3 to 6 months, whereas a house,
You can get someone in the next week. Yeah. Look, I think with that as well, that's just where you need to be careful. If you're looking at that commercial investment, getting the right asset, it's always going to be easy to lease.
But are you seeing that now with what trends are you seeing now when people come? Are they more commercial? Are they more resi? What?
I think that most of the people we're dealing with at the moment are more residential based. I feel like, and we've kind of discussed this, I feel like people get to a point with the residential portfolio and then start going to commercial. I think when they're tapped out with certain lenders with borrowing capacity, and then they start looking at, lease stock loans.
Topic for another day.
Yeah.
Self-managed super fund lending, commercial properties. It's a very, a new lender's just entered the market, but it's a very, it's an area that the younger generation need to be educated on. That's the
What's the advantage of this new lender?
There's no new advantage. At the moment, it was only 5. Well, having a new lender on the market, it just gives a more diverse range.
Yeah.
But people don't understand the power of investing within your super for property, particularly commercial, right? So we've got a financial plan division. Yeah, we've got a financial plan division that will be able to discuss that in further detail. But self-managed super fund sits there. Why not utilize that in the event there's enough?
Especially if you're a business owner where you can buy your business premises and then lease it back to yourself.
Correct. I just believe your generation, my generation is slowly getting into it, but your generation is deep dive into it from now and to get a clear understanding.
I think it's very important at a, young and mature age to get into the investment side of things and, secure your future early,
Absolutely.
if that makes sense.
You can't save the 5 to 7% growth that you're going to get every year on a property. Like you said, as soon as you can get in,
You can get, are you referring to commercial?
I'm referring to any property in general. If you're buying the right property, you're going to get, not even rental returns, I'm talking about capital growth.
For residential, yes.
Yep.
And as you mentioned, the commercial, you get a high yield, but majority of the time for rental, but not for capital growth.
It all ends up evening out because as soon as your lease goes up 3% or CPI every year, the value of it goes up as well, depending on the cap rate that's used at the time.
But also when it comes down to market drivers, you got interest rates, government policies and migration trends. With the interest rates, that's impacting housing affordability and the borrowing capacity. We know that. Your incentives, first home buyers.
Well, what do you reckon if we get one rate drop, say 0.25, what do you think that's going to do to people's borrowing capacity?
At the beginning of the year, I thought there'll be 2 to 4 and only 2 came through. I sound like a negative Nancy. I think we need that extra one because maybe that extra one would have tipped
a lot of people over.
Well, no, not in the negative aspect, but I would have tightened the belt sooner and we may have had a conversation around rate decreases.
Already, yeah.
Right? But we're not at that stage for whatever reason. There's light at the end of the tunnel. But to give you an answer, 0.25 on over 100,000 is $2,500. On a grand scheme of things, probably around 4 to 5 grand difference over the course of the year. So it could increase borrowing by anywhere from 30 to 50,000. However, we haven't got those accurate figures around us. We know when we do different lenders at the 3% buffer, 2% buffer, which we've discussed before, you get the difference between 50 to 150,000.
Yeah, obviously every case.
So there will be a difference. But in saying that, until such time, look, somebody's got to give. Either the buffer rate reduces, which gives more, but
or their interest rate.
The RBA are not giving much away at the moment. And I believe what they're doing to some degrees correct, where they need to see the true reflection. So to answer your question, you're going to see a 5 to 10% difference in borrowing capacity. And don't forget the full financial, your tax savings as well will factor in that. So dipping that into it, plus the rate decrease. Government policies, as we mentioned before, first homeowner grants, tax benefits can influence property market by homeownership and supporting that. The both international migration and interstate moves impact demand. Melbourne is growing at a rapid pace because people are migrating to a quieter, little bit colder area. But Sydney's the place to be.
100%.
At the moment, Sydney's the place to be.
Growth, business, trends, it's where you want to be. If you got the affordability for it. But
where's that, sorry?
If you can afford it. In Sydney.
Nah, Sydney's overpopulated. I shouldn't say that, should I? But look, real estate and finance are crucial elements of a household. You may rent, but you may also need finance to purchase a vehicle, purchase a furniture. You may have enough cash saved up and go to buy a property and you're going to need a real estate agent. Nobody, very rarely do people advertise to Trading Post.
Yeah, you've got a couple, but they end up coming on with a real estate eventually.
Yeah, but it's the two key areas.
Yeah.
Like financial planning. It's more of a want. It's not a need. You don't need a financial advisor. You can ring up rural insurance and do it all. Real estate and finance. You can ring a bank. It's only this morning I was having a conversation. Our bank is going to help us.
But how many times have we had mutual clients that we've ended up sending them your way, and how much they've saved on interest, even increasing their borrowing capacity?
I had a client the other day, just a 5-minute conversation. I was able to get him an extra $300,000
Just by the changing the lender.
just by giving other options, seeing the circumstances, and actually going through his situation. Whereas,
But if you went through his objectives, and the problem that you get when you go to a bank, this is how it is, take it or leave it. When you come to a broker like yourself, it's in your best interest to play the infinite game and add value to the relationship, correct?
correct.
And that's what you did.
Yeah. I mean, you go to a bank, you're stuck with their policy, how they review you and your circumstances. Whereas you go to a broker, we have many access to lenders, right? And we can review those circumstances and objectives against all the other lenders.
So in a nutshell, recapping, the market trends, investment opportunities, and the market drivers all those three play a key element in the real estate market and how diverse it is, and it varies. And again, to come to the conclusion, you need to have a good relationship with your broker and your real estate agent, whether they work separately or together. But it's like a puzzle, connecting them all and painting a picture. And I believe, Jason, having dealt with you for a very long time, Andrew and I see that benefit and that value, and we know we can help our clientele.
Yeah, well, exactly the same with us. You've been able to help a number of our clients, me personally, my family personally. So what you do is incredible, and we're lucky to have you.
Appreciate you.
No worries.
Jason McHale, property expert from the Property Co Group. Thank you so much for joining us once again, and we look forward to having you on.
For a third time.
Maybe fourth. Who knows?
Thanks for having me.
Seems to invite himself, but doesn't matter.
Thanks a lot.